My name is Abdel Misa and thank you for watching. In this video, I will propose economic and market solutions to combat the coronavirus crisis. But first thing first, I would like to send my thoughts and prayers to anybody that has been affected physically, emotionally, or economically by the coronavirus. Please stay strong in this extremely challenging environment. We will fight and prevail together. Second, if you like my content, please subscribe to my YouTube channel, Abdel Misa Finance for All. It's purely educational and philanthropic, and it's 100% free. So let's get started. Please don't have any illusions about this. We are at war with the coronavirus. There needs to be a great sense of urgency among all of us. Think about it from the perspective of natural disasters. Think hurricanes, Katrina, Maria, Harvey. Think about the awful Japan earthquakes and tsunami. Think about the devastating wildfires in California and Australia. Well, here is the bad news. From an economic standpoint, the coronavirus can become worse than all of them combined. Yes, you heard me right. You put all of these nasty natural disasters together, and we can be worse economically if we do not act fast and smart. That's the monster we are dealing with. However, here is the good news. If we respond and act with a sense of urgency, like we are capable of, we will in fact come out of this crisis stronger than ever before. Obviously, there are two angles to the crisis, the health angle and then the economic/market angle. I am not a doctor, so please listen to our health experts. Please wash your hands frequently and maintain social distancing, which will drop infection rates and flatten the curve. Also, there is no doubt in my mind that our brilliant scientists will come up with an effective treatment over the short term and a permanent solution over the long term. They just need a little bit of time, and they have our full support. So let's now focus on potential economic and market solutions to the coronavirus crisis. I will cover both monetary policy and fiscal policy. The US Central Bank, or the Federal Reserve, which is also called the Fed, has already taken draconian measures to fight the crisis. But it has not been enough. Let me walk you through some of the major steps taken so far by the Fed. March 3rd, 2020, the Fed surprises markets and lowers the Fed fund rate by 50 basis points. And guess what the equity market did? It sold off 4% after the Fed announcement. March 12, 2020, Fed announces that it's ready to pump more than $1 trillion in the overnight repo markets. And guess again how equity markets reacted. The S&P sold off 9.5%. And on Sunday, March 15th, the Fed threw in the bazooka. Get out of the way! Fed funds and reserve requirements goes to zero. And the Fed announces $700 billion in quantitative easing. And here we go again. You can guess how the stock market responded. It basically gave the Fed the finger and sold off an unbelievable 12% on March 16th. Look, let me ask you this. What do you think is the most important asset of the Fed? I would argue it's their credibility. It's ironic that in the past 10 years, you have heard the saying multiple times, don't fight the Fed, don't fight the Fed. And you know why? It's because the Fed established huge credibility by using innovative solutions to defeat the financial crisis, including quantitative easing and lowering interest rates to zero. And now you read everywhere that the Fed is out of ammunition and that this is not a monetary crisis. That includes Ray Dalio, the founder of Bridgewater, the largest hedge fund in the world. He recently said that the Fed has done all it can do for now. Well. I am definitely not in that camp and could not disagree more. I am telling you, never underestimate the Federal Reserve. They are very creative and they will continue to innovate and use a new playbook to defeat this crisis. Of course, they do need help on the fiscal side, but here are some suggestions on how the Federal Reserve can expand its actions a step further and re-establish its credibility. Number one, the Fed needs to work with the Treasury to get an approval from Congress to give it at least temporary emergency powers to expand the type of assets it can purchase, including corporate bonds and equities such as ETFs. By the way, this has been done before in Japan and Europe. Today, the Fed does not have that authority due to the Federal Reserve Act. To date, the Fed has done an excellent job lowering rates and providing liquidity. However, it has failed to address the stock market crash and the corporate bond crash. Not because it can't, but because it does not have the authority to do so. Let me give you an analogy. It's like if you really like someone, and instead of asking them out directly for a date, you go ask their best friend for help. So stop dancing around the issue. Yes, lowering rates and QE helps the stock and the corporate bond market indirectly. It has worked in the financial crisis, but not here because rates are already very low. The Fed has got to be the liquidity provider of last resort for corporate bonds and equities when everything else fails. There are no two ways about it. Congress needs to expand the power of the Fed, at least temporarily, to allow them to purchase other assets. What are we waiting for? Just imagine the headline: Fed to buy $1 trillion of corporate bond and equity ETF. I'll bet you the stock market does not sell off 12% then. The ironic thing is they don't actually need to buy $1 trillion, they just need to communicate it. This will revive the Fed put, which is much needed right now. So why do we require such a drastic measure? Well, let's make an analogy. A bank run. You could have, in fact, a solid bank, and if rumors start that the bank is going under, everybody panics and rushes to the bank to get their cash, which of course makes the situation worse and can cause the bank to go under. A self-fulfilling prophecy. And that's why we need the Fed. It can step in to become the liquidity provider of last resort. Same thing here. We have a major liquidity crisis in the stock and corporate bond market. There is no liquidity out there. I mean, none, which has amplified the market turmoil. And that's why Congress needs to unleash the full power of the Fed. But let's take a step back and be responsible and good risk managers. Let's think about the risk for the federal government. As you know, the Fed has a limited printing power, and they can hold their assets for the long term. So let's look at the case of buying equity ETFs. As you know, the stock market has generated historically 10% over the long term, including dividends. You can actually, in fact, argue that the risk of owning stocks over the long term is less than owning Treasury bonds. Ironically, by doing this, the Fed and Treasury will make tons of money while stepping in to provide the much needed liquidity. This is especially true in this case, in this crisis, which is not structural by nature and most likely temporary. So it's really not rocket science here. It's buy low, sell high, right? The great Warren Buffett once said, be greedy when others are fearful, and fearful when others are greedy. Well, ladies and gentlemen, there is panic and blood in the street. The risk of the Fed buying corporate bonds and equity ETFs is actually very minimal over the long term. In fact, I would argue the risk is the other way around. If they don't step in and act as the liquidity provider of last resort, that's how you get 35% sell-offs in a few weeks. And that's how you lose in less than a month the credibility that you have been building for decades. Here is another thing they could do. Implement some regulations around liquidity. An old colleague of mine, Tony Myers, has always made the argument that liquidity was higher in the old days of floor trading. In fact, when I used to work at Deutsche Bank, my team gave Tony the nickname Tony Liquidity Myers. My team and I argued that algorithms provide, of course, more liquidity than humans because they are faster. Well, Tony, you have clearly won the argument, and here is why. Algos provide you tons of liquidity right when you don't need it. When markets are calm, you can find as much liquidity as you need. When things are good, algos provide you as much liquidity as you want. But right when you need the liquidity the most, in times of panic and turmoil, that's when they disappear. Wait, where did my liquidity go? I can't find it. It must be hiding somewhere and I really need it to show up right now. But it never does. And here is the proof. Check out this chart from the quant team at SocGen that they put together. The gray line represents the volume traded, i.e. volume. The red line represents the liquidity offered. As you can see on the right side of the chart, exactly at the time when demand goes up through the roof, supply actually disappears thanks to these nasty algorithms. So you might ask, why? Well, these algos are more and more sophisticated. When it gets dangerous and volatile out there, they take a step back and reduce their liquidity. It's like if they tell you, see ya next time when I can take advantage of you again. There is no question in my mind that this amplifies sell-offs. I mean, we are dealing with limit downs on a daily basis. It's absolutely nuts out there. I have never seen this before, even in the worst part of the financial crisis. So the Fed and regulators need to do something about this. For example, they can set liquidity thresholds that market makers and high-frequency players need to abide by. So if you're offering this much liquidity in the past X number of days, you can't go below this level in the following Y number of days. I think this is really critical for the smooth functioning of financial markets. In summary, these potential monetary policies will help restore the credibility of the Fed, which is again its most important asset. Let's not now switch gears and cover fiscal policy. We are dealing with a different animal vis-à-vis the financial crisis in 2008. Politically, it should be easier, although that's not what we are witnessing, unfortunately. I mean, we are not bailing out greedy Wall Street. We are bailing out everybody, and it's certainly not their fault. Like, you can't blame airlines for what's happening. Sure, they were buying back stock, but come on, this virus is not their own doing. So what the country needs right now is for both sides of the aisle to collaborate to get it done. Currently, Republicans and Democrats are discussing phase 3 of the stimulus, which will include cash handouts. But here we go again. We are dealing with a stalemate on how to target funding. A stalemate is good for no one. So come on, Congress, get it figured out quickly and get it done. By the way, I think we should go even bigger than what is proposed in the bill right now. We need to put people to work and rebuild the nation's outdated highways, airport, bridges, and other infrastructure. The time to do it is right now, and we need to seize this opportunity as a country to make transformational changes that benefit all of us. I also want to address a very important question. What's the long-term effect of the increased debt to finance this gigantic stimulus? Here's the good news. We have debt capacity. Our debt to GDP stands around 100%. In Japan, it's 253%, with much more demographic headwinds. So we can definitely handle this. The other good news is interest rates are low. You are looking at the 30-year around 1.3%. And interest rates should remain low due to the quantitative easing programs from central banks around the world. The third good news is that the Treasury is looking to issue more longer-term bonds, including 50 years. I think this is a great idea to spread out the cost given the circumstances. It's also timely and allows the Treasury to take advantage of the low interest rate environment. And finally, let's be pragmatic. Say you don't do anything, or you go for a small stimulus package. Guess what happens? We go into a depression, and the cost then will be much higher. Trust me, nobody wants such a scenario, including you. So it's a really simple and straightforward decision. It's go big or go home. And we need, as a country, to go big like we have always done. One last point I would like to mention on the fiscal side. There is over $8 trillion of cash parked outside the US for S&P 500 companies. It's time to bring that cash back home. However, we cannot allow it to be used for share buybacks and dividends. Companies must be required to reinvest it in the economy through additional capex, for example, or bonuses to their employees. In exchange, the government will offer a lower tax rate and require a percentage of the cash to be donated to non-profit organizations selected by each company to help combat the coronavirus. A successful partnership between government, the non-profit sector, and corporates is needed to combat this crisis. And this is one potential way to create a win-win situation for everybody involved. Bottom line, the coronavirus is a serious health and economic crisis. I have offered in this video observations, ideas, and potential solutions to help combat the economic and market effects of this challenging crisis. So please spread the word and share the video. Do not do it for me. Do it for the sake of our country and for the sake of humanity. Thank you for watching, and please subscribe to my YouTube channel, Abdel Misa Finance for All. Thank you so much for your support, and I will see you next time.